There is some relief for those of you looking to buy an apartment here in New York City. According to a report by Miller, Samuel, and Prudential, the cost of all condos and co-ops in Manhattan fell 0.9% in the first quarter from last year. The median price of apartments dropped to $775,000. However, for those of you with renting in mind, there is no break. The median effective rent rose 9.5% in the fourth quarter of last year to $3,121 a month. And this trend of skyrocketing rents and lower home prices is something our next guest knows plenty about. He is Billy Macklowe, the founder and CEO of William Macklowe Co, the real estate investment firm. And you are actually looking at building condos right now in New York. Is that right?
That's correct. We're exploring a ground-up development situation at present.
Okay, so Billy, when you hear statistics like what I just said, give me the real dirt on that. What's the real story behind that?
Well, I think it's an interesting statistic, and as we know, sort of real estate, especially residential real estate, is a bit of a great spectator sport and a blood sport in Manhattan at the same time.
You need to have thick skin, I think.
Absolutely, for all facets of real estate.
Right.
You're seeing great pressure on residential rents, and you have this dynamic in Manhattan where the cost of land sort of really inhibits the ability to develop rental housing. So that continues to put upwards pricing pressure on rents, and the question is, does it ever hit a glass ceiling? And
so far, no, right?
So far, no.
Okay.
But we don't know yet. Occupancy is at historic highs, rents are at historic highs, and now you're seeing a shift back to the entry-level purchaser buying condominiums. So I think that 0.9 of a dip in pricing that the Miller-Samuels report indicates is more indicative of kind of lower end pricing or smaller aggregate dollar purchases versus the high end.
You mean so there's more demand then on the lower end condos then, right? And so is that where you would want to build?
Not necessarily. I think you have to look at cycles. Remember, construction is not something that happens overnight. It takes a good year at least to plan a proper building, and then another 12, 14, 18, 24 months to actually execute on construction.
So you want to stay high end then?
I think we want to stay high end. We're not looking to develop into burgeoning neighborhoods. We like traditional, time-tested neighborhoods that have
established places then.
A little bit of a value buffer in there.
Okay. Last time you were on, Billy, you were talking about that you're raising funds and raising up to, I think, $1.5 billion to deploy. So have you raised that amount of money, or do you have that amount of money, and are you finding it difficult to deploy that cash?
A lot of questions. Yes, we have cash to deploy. Our fundraising efforts have concluded, so we feel very good. We're capitalized, we're ready to go. There seems to be, like there's a shortage of apartments available to rent, there's a shortage of investment product on the market.
Okay, why is that?
I think people are having a hard time replacing money. We're in a pretty much a zero yield environment, and you can see that assets sort of at or near a perfection level of pricing makes it hard for people. While it's enticing and attractive to take big gains, they don't know where to recreate the income or the asset value they're selling away.
So you need to come in and do what then in order to get the property off the hands of these investors then?
I think you have to be aggressive, you have to be smart, and you have to really be investing with just an extreme degree of conviction and your ability to execute on your business plan.
What is going to change that scenario?
Perhaps a forward look on changes in the tax code, maybe as the year progresses. I think so. I think if you see big changes in capital gains, will the Bush tax cuts get extended or not? We saw that 2 years ago as it looked like they were going to expire towards year end, and that created a rush of sales activity. At some point also, sort of given the complexity, the complexion of ownership in New York, while it's not just families and individuals, it's sort of institutional and to a certain extent fund driven as well. At a certain point, money has to come home to investors after a harvest period. And that should also put property on the market.
Billy, just quickly, one of your properties, or the one that you had bought, was 636 6th Avenue, and one of your anchor tenants is Second Market. But we know from the news is that they've laid off 10% of their workforce. Are you concerned? I mean, are they going to have to scale back, or have you locked them in for several years? What's the deal there?
I think Second Market is a very nimble, agile company. They're a new company. They're an innovator. They've created a space that heretofore really did not exist. And I think they're showing themselves to be adept business owners. They see that their golden goose right now is disappearing, and they're providing for that, and as they manage kind of their G&A footprint. And we're respectful of that. They seem to be going into different product areas. They're going to test the market. There's always another Facebook. perhaps
Right.
not at that level, but there's always going to be that market where companies need some liquidity event between, initial stages, Series A, B, and C rounds, and then ultimate, exits.
But has Second Market come back to you with changing the terms of their lease?
No, absolutely not. They're
Okay.
committed to the building, and this will be their world headquarters.
Okay, Billy, great to see you again.
Seeing you,
Thank you for
Betty.
stopping by and in the loop. Billy Macklowe of William Macklowe Company.